there's also even, well, we can get into China if you want to, but there's even some speculative opportunities within China that I think are legitimate versus illegitimate businesses. But
Okay,
yes.
so on the China point, obviously there's the looming question of like Alibaba. There's Tencent. There's sort of the massive tiger like huge corporations in China that even lured people like say Charlie Munger into a Baba position that ultimately got him rather burned. So
Yes.
how do you navigate such complex and oftentimes politically polarizing landscape for investing in a foreign country like that? Because usually the precursor for me before allocating capital to a foreign nation is, like you said, you want to make sure they have a business culture, but also a regulatory environment that's at least, it doesn't even have to be favorable, but at the very least respectful of shareholder rights, if that makes sense. So I think there's a lot of concern surrounding China in the sense that you're owning an ADR, you're not necessarily owning the underlying asset. There's a lot of concern around the Chinese government could swing back in the other direction and sort of crack down on private industry. What are your thoughts on that, and what opportunities do you see coming out of China?
So the China question, yes, has been very polarizing. So I think people feel really opinionated about it on both sides. But I think that more recently it's become more popular to be anti China stocks. But I think that if you take that approach from the get-go, I think you'll save yourself a lot of heartache and mistakes of avoiding countries, environments that are just not very business friendly, where you as an investor have to do the extra legwork. I would leave it to the Coca-Colas of the world to establish subsidiaries and control the subsidiaries, and I guarantee you they'll manage it better than someone like, let's say, I want to put capital to work in a domestic business from that country in an environment that may not respect me as an investor. So China, if you want me to get into the whole structure issues, but there it's not the case. That is not the case. The opportunities in China are nuanced in the sense that what I was alluding to just now was not all companies are structured favorably. So, and I think investing is extraordinarily nuanced, especially when you invest in individual securities. Looking at China, there's what you call a variable interest entity, which is an umbrella term used to describe the structural design of, ownership. And it could look in a variety of ways. And I think the Chinese version of a VIE is absolutely horrendous and an abomination. But I appreciate it for its intelligent design and way to circumnavigate the law in China. But not all companies within China that are publicly traded are structured that way, thankfully. You can find businesses within China that are publicly traded, and you can actually own shares, maybe not voting rights, but you can actually own shares of the business and benefit economically from it, or at least not worry about, not benefiting economically from it. So I have to almost go into, some of the nuances here because Alibaba, which I talked about a lot on YouTube just because it's so popular and so people resonate with it. But Alibaba is structured as a variable interest entity. What you own as an American, and even if you're buying it in Hong Kong, is literally a contract. So not actual ownership of the business. And there is a difference between contract law and property law or ownership. And so ownership rights are much stronger than contract. And so the contractual obligations are quite, let's call, vague to say the least. And the benefit of having the structure for Alibaba is that they can raise capital, and the capital actually doesn't come at a cost of equity ownership. It comes at a cost of an agreement of shared profits, but not actual equity for going. So typically when you look at debt, right, when you are investing in bonds or the debt of a business, yeah, you're not getting equity in it, but you have some economic interest in the entity through contractual obligations, and the contractual obligations have a time stipulation, meaning they have a maturity and end time. Well, with this, there's no end time. I could go through this agreement with you, and I could, set this up, and you give me money, and I never tell you when I'm going to give money back to you because you have common stock in an entity that has agreements with me, but there's no agreement as to when I have to give you money. I could never give you money if I wanted to, and I would not have run afoul of our agreement. So even like with preferred stock, at the very least, a preferred stock, the rules are quite simple for the most part, that you won't get cash payments if no one gets cash payments. But if the common stockholders get cash distributions, you have to get cash distributions first. So at the very least, you're protecting that. And then again, a bond has a time stipulation
Well,
or an
couldn't you?
expiration.
Sorry to interrupt, but couldn't you say the same of traditional common equity in a business in the sense that if you buy shares in any company that doesn't pay out cash directly to shareholders, you could apply the same line of thinking, right?
Correct. However, you do have at the end of the day the equity ownership. So you own the actual business. There's an actual ownership. But what I'm saying here is you didn't get the ownership, but then you're being treated as if it was like a contract.
Yeah. Yep.
But because it's a contract, normally the benefit of having a contractual agreement is that there's time stipulations. So I'm getting the best of both. I'm not giving you equity, and I'm treating you as if it's a contract, but I'm don't even have time stipulations with you. There's no we didn't agree to any time, but I didn't give you equity to begin with. So in the other way, I gave you equity. So that means that if at the end of the day, if anything, you are an owner of the actual business that we're discussing. And why that's important, if you look at the historical treatment of Yahoo, this is the one that people really forget, and that's what I'm talking about. People maybe have short memories, but this is really, it just happened. I think 20 years is nothing in the grand scheme of things. But in 2012 or so, the Reuters article came out. The journalist was so surprised by the following scenario or situation. So what happened was SoftBank and Yahoo owned a large stake in Alibaba. And Ant Financial, which was a business inside of Alibaba, was spun off and given to Jack Ma. But there was no compensation to Alibaba shareholders. So, to give an analogy of what that would be like here in the United States, imagine if Amazon spins off Amazon Web Services to Jeff Bezos and the Amazon shareholders get nothing. So right off the bat, that would be, okay, that's illegal, et cetera, blah, blah, blah. In China, that wasn't. And what ended up happening was, of course, Yahoo and SoftBank sued Alibaba in Chinese courts. They were obviously going to lose. They ended up settling, but I'll tell you why they settled, because, and the settling was pennies on the dollar, like literally just like a tokenized payment. The reason why they had to accept the settlement, they had to basically accept the theft. I'm going to just call it straight up what it is. The theft of one of the crown jewels of Alibaba was because at the time, and going back in history, Alibaba as a percentage of SoftBank's portfolio was quite large. And for Yahoo, it was everything. So when you looked at Yahoo stock back in those days, and you looked at what their value on the books were, it was all Alibaba. And so what would happen if you were to admit that you never owned the assets in the first place? As in, you pursue this lawsuit to the very end. Like, you don't accept that they do this to you. You say, no, I can't accept that you do this to me. I'm going to take you to court. I'm going to fight this theft. Well, what would you have to conclude at the very end of that? And by the way, there were prior hearings that had undergone in China with other businesses. The conclusions were always the same. The court decided or said, you never owned anything to begin with. You have no rights in this court. We don't recognize any of your rights.
Wow.
So
okay.
Imagine if they went through with it. What would they have to say to their shareholders in the United States or elsewhere in the world? Oh, sorry, guys. Turns out all that value on the balance sheet, yeah, it's not worth anything. We never owned anything. We had, it's a facade. So of course, if you're the CEO at the time of Yahoo, what are you going to do? Of course, you're going to take the deal. You're going to keep the facade going. You're incentivized not to admit that you owned nothing. You take the chump change and you accept the theft and you move on with your day. And later on, Yahoo spins off the Alibaba ownership in an alternative entity called Altaba. which is no longer publicly traded because thankfully they did good by their shareholders, by the way. They kept the facade going as long as they could and they liquidated. And they liquidated, I think, in 2019 or 2020. So I could be off 1 or 2 years. The time starts to get weird after so many years. But
Yeah.
um, they're no longer with us. And actually, if you own that entity through and through, you ended up doing fine because they liquidated at a right time. If they had held on, you would have not been happy. But that's another story. So.
What opportunities do you see based out of China currently?
I think that if you're looking at it from a trader's perspective, there's a sentiment trade to be had. Right now, China is hated. I think it deserves it, but the market does not treat it the way it should be treated. In fact, if everyone thought like me, the way I know market participants are definitely not thinking like me. I think that they're not worth zero, but they're worth close to zero. All of the VIE assets, they should be worth close to zero because there's always the chance that there's a regime change and the laws change, and then they will recognize all those shares as actual ownership, and there's going to be some convergence. That could happen. So, but there's also the fear that, of course, there's going to be some sort of geopolitical conflict. If that happens, anything that you buy within China, even American businesses, assets within China, all that's you should value it at zero. But if you want to bet on peace happening, there are assets in China that should or could lead to really good returns. I'll give one of the ones that I recently discussed was Yum Brands China, Yumc. So here you have a business, and by the way, um, you this is actually another point to hit home. You will see the difference in how they treat shareholders depending on the structure. So if your audience pulls up while they're listening to this, or you can just trust me on these numbers, if you pull up Alibaba or JD's balance sheets right now, and you see how much cash they have versus debt, you'll see they have a massive net cash position, and they just issued more debt, convertible notes. Jim Chanos is on this. Some people have mixed feelings about Jim Chanos, but in this, me and Jim Chanos are actually in agreement on. But it's very suspicious. If you're looking at any business and you see a massive net cash position, and you're trading at the cheapest valuation that you've ever traded at, you would think, oh, these buybacks, they should be going crazy with these buybacks, but they're not, which is a red flag. They're doing some buybacks, but not as much as you would think. And they have a massive net cash position, but they're doing a convertible debt offering. So something's weird. They have way more cash than they could ever need for reinvesting back into the business. They're producing tremendous amounts of free cash flow. And I'm assuming all the numbers are correct. Something's weird there. It doesn't check out. I don't see this behavior with any kind of business anywhere in the world, just here in this country where there's this weird structure. And I'm looking at another business, Yum China, where they are putting almost 100% of the cash flows that they generate back to the shareholders in the form of dividends and buybacks. And they're not structured the same way. So basically what I'm getting at is you probably will do better if there is peace and the sentiment reverts in names like Alibaba, but just I wouldn't be comfortable owning them in a serious way because I know at the end of the day, I don't own anything and there could be something really bad that's like a gray rhino that occurs with that. But with at least Yum China, I know that my incentives are at least aligned. I actually have ownership in this thing, and if I bought shares of Yum China, it'd be basically making a bet that there will be peace. Because if there isn't peace, if there is something, first of all, a lot of other names in my portfolio are going to be cratering, but I would value Yum China basically at zero. It'd be the equivalent of your ownership stake in Gazprom if you bought Gazprom right before the Ukrainian war. Same thing here.
So
I don't.
how do you go about positioning if you did think there was going to be military conflict with China?
So that is a very interesting war game scenario. Not war game as in the war, but just war games in general, strategy for the portfolio that I've been thinking of. And right now, I've actually started to try to position myself. I mean, nothing beats treasuries. All right. If you're really scared, nothing beats treasuries. Just saying that right off the bat, or CDs, short-term treasuries and CDs. But if you're trying to play equities, beneficiaries in the equity space, I mean, you could go military defense contractors and maybe make an argument for pharma. Companies that do not care what the economy is doing, et cetera, and their cash flows are going to be relatively secured. But frankly, I don't think there was going to be anything. off the top of my head. Like I even think that we could see a sell-off even in military defense contractors. So like I said, I started off by saying nothing beats treasuries. Um,
Huh.
in a war, yeah, like if you're now saying because the Russian-Ukrainian war was one that we're not directly involved in. This one may be, I don't want to be a warmonger, sound like I'm a warmonger, but maybe this one will involve the United States in an active conflict.
Yeah,
I have
there's
no
lower risk
idea.
of a direct nuclear exchange.
Yeah,
So the possibility of a conventional war becomes a lot more viable.
correct, correct. And I mean, in both conventional war in the across Taiwan would be have a lot of implications around the semiconductor space because one thing people don't know it's not just Taiwan Semi. It's there is if you talk to semiconductor engineers, they'll tell you all about the very delicate supply chains that makes up the entire semiconductor industry, right? The semiconductor industry relies on the existence of regional peace because there is so many like in some countries there's like very important but small crucial players that they're in that country and now all of a sudden you say there's war in the South China Sea. Oof, we may not get that one component, and you might not have been thinking of that one component, and now the whole thing is under question.
Hmm.
So, I mean, I'm looking at my portfolio, and I'd say, yeah, Taiwan Semiconductor, that would probably be either the generational buying opportunity, like a true generational buying opportunity, betting on on the other side of this thing, there's peace, and it could be dead money for 2 or 3 years, um, or it will be, let's say, potentially how you're positioned, very painful and just painful, no opportunity.